All right, we should be all set. Thank you, everyone, for tuning in today. We have Shane Theriot with Edward Jones. As you know, he gives us quarterly market updates. We thought we'd bring one to you regarding what the status of the market would look like and anything that he can let us know about after the presidential inauguration. So, Shane, go ahead and take it away.
Good morning, my friend, and my friends out there in the virtual universe. To give you guys some updates, some takeaways from what we learned from last year, kind of what to look forward to over the next 6 months or so as we move into 2021, and then some takeaways for you for some actionable items that you could use this year. I'll start with a little bit of a look backwards at what happened last year as far as numbers are concerned. On a positive note, the Dow did end 2020 up 9.72%. The S&P ended last year up 18.39%, and the NASDAQ closed up 45%. So I'd say, considering the year that we had with the massive 35% pullback in the markets in March, the markets came a long way before the end of the year. If we're looking at fixed mortgage rates, your 30-year fixed mortgage rates are under 3%. It's been a long time since they've been in that range. You've probably noticed that the price of gas at the fuel pump has increased as well. West Texas crude is about $52 a barrel or so as of my last report that I'm looking at. The Fed has decided to keep their lending rates near zero at 0.25. You've probably noticed that on your yields, on your checking, savings, and any CDs that you may have out there. Inflation has hovered around 1.6. The Fed said that they want to keep a target of around an average of 2%. So expect for that to go over 2% slightly as we move into 2022, 2023. Unemployment pre-pandemic was about 3.5%, skyrocketed in March, April, and as we move through 2020. But we ended the year last year at 6.7, so just under double unemployment from the beginning of 2020. GDP on an annualized rate is moving in the right direction, coming off the worst quarter in Q2 into Q3, where we saw acceleration based on pent-up consumer demand. Initial unemployment claims as of last Thursday were about 965,000. Moving in the wrong direction. We would like to see that number decreasing, and it had been around 800 or less for a couple of weeks in a row. Haven't looked at the numbers yet this morning to see what they are because they're released on Thursdays, but my assumption would be it's somewhere between 700 and 900,000. Also, consumer confidence seems to be waning a little bit, closing out December slightly below November. November was around 93%, and December closed around 88, 89%. Looking forward to 2021 as we move into the first part of spring this year, coming off of inauguration this week and then the events that happened in DC 2 weeks ago. We want to look at a few key highlights so you'll have an idea of kind of what to expect. There is disparity between what occurs in the economy and what occurs in the actual markets. The economy is what we're living in right now, here every day, our day-to-day living. Markets tend to look forward about 6 months, sometimes 12 months, and they've already priced in a lot of things happening this year, like getting the pandemic more under control as vaccinations become available, not just in our country, but globally. So we'll start with the outlook for this coming year. After a year that upended social and market norms, the distribution of vaccinations should allow our economy and the global economy to return to new norms as we progress through the year. Household consumption is expected to remain the backbone of GDP or gross domestic product, but spending habits will be slightly different this year. Probably a little bit more towards e-commerce as we saw occur in 2021 with less retail storefront spending, possibly a norm going forward. The labor market is poised to continue to improve as the vaccination becomes available and your employers can start pulling people back to work. The labor market will benefit from increased productivity, rising wages, Office settings, however, are likely to look a little bit different, as well as commutes, as more people are given the liberty to continue working from home, at least for the first couple of months, first half of this year. We do believe as a firm that we're in the initial stages of a new expansionary cycle and a bull market that began in April, coming off of the lows in March because of the pandemic-induced recession, offering favorable runways for financial markets, meaning the Dow, S&P, and NASDAQ over time. We do expect bumps in the road or hiccups with markets along the way as conditions look to live up to expectations that have driven our strong stock market over the last year, specifically the last 10 months or so. The economy is expected to get a boost from a shift in the post-vaccine phase, as well as additional COVID relief. 2020 did have the largest quarterly decline in Q2, as well as the largest quarterly increase in Q3 in US gross domestic product on record. The pandemic-induced shutdown and partial reopening produced seismic swings in consumer consumption as well as output. We do expect a smoother trajectory in 2021 with above average GDP growth of more than around 4% for the full year this year. We anticipate tepid expansion in the early portion of this year, stunted by lingering measures to slow the spread of COVID-19. Growth should accelerate as the vaccines become widely available, allowing consumers to return to work, leisure and travel activities to return as well to more sustainable levels. One thing to keep in mind with COVID-19 is you've probably heard, read, or seen on the news information about new strains that have come out there. And what we're looking for is definitive answers from those companies out there that have produced vaccines, two available here in the US from Pfizer and Moderna, an additional third one with AstraZeneca available outside of the US, hopefully here soon, and then Johnson & Johnson working on a one-dose option. How effective are those not only against the initial strain of COVID-19, but also the new strains that have been discovered? We do think 2021 will be the beginning of a multi-year economic expansion with widespread distribution of the vaccine, sparking progress towards a new normal for the US economy. Meanwhile, the one-two punch of monetary and fiscal policy stimulus will keep a tailwind at the economy's back. One thing we do want to keep in mind is Biden did announce that the recent $900 billion stimulus was just an advance basically on what he has proposed in a $1.9 trillion stimulus package he hopes to come. It may end up being piecemealed as we navigate through an equally divided Senate. However, it is something that's on his mind, whether it's piecemealed or in one package. We do expect consumer spending to remain roughly about 70-75% of GDP. That's pretty much what runs our economy, but habits are notably changing. We saw that more people were comfortable with e-commerce, things being delivered to their house, different ways of doing business, working from home. So we'll pay attention to how those things move forward throughout 2021. Increased online shopping, strengthening in the housing market has been quite interesting as the year progressed. You have more people moving out of larger cities to your suburban areas and your rural areas, realizing that they actually have the ability and their companies are affording them the opportunity to work from home. Housing related purchases continue to move in the right direction. Here locally, I've talked with many of my peers in the real estate industry, and they're like, we just don't have a lot of inventory available because people are moving about, either upgrading homes, downgrading to smaller homes if they're moving into a retirement space and empty nesters, or people coming from the city out to the Katy area. We're also anticipating that larger work from home base that I mentioned moments ago, shifts in commercial real estate. That's a big one that we're seeing impacted. Certainly if you have any real estate investment trusts in your portfolio, they're probably are likely down in value just simply because retail space now is questionable with the ability to work from home and order most goods online. Increased automation and adjustments to business travel are also a noticeable impact coming off of the pandemic last year as we navigate into the new year, since most things can be done virtually now using Zoom, WebEx, or any of the newcomers in that playing field. Along with labor market improvements, we can see support in healthy household consumption growth with residual pent-up demand. Higher labor productivity gains are expected, similar to trends that we saw in the 90s, which will be a key driver for GDP this year as well. The resiliency and vibrancy of our economy should show as the year progresses. With GDP entering the year below pre-pandemic levels this year, sufficient slack remains to fuel above average growth as the recovery gains traction. Over the last 40 years, GDP has averaged about 3.4% in the first year of an expansion, compared with an overall average of 2.6% since 1980. While we do anticipate GDP growth to settle back towards modest levels as the expansion continues, stronger growth this year should form a reasonable, firm foundation for corporate profits and stock market performance. Unemployment does continue to decline, supporting a consumer comeback. Further improvements in the labor market will be a key driver to durable, self-sustaining recovery this year. The unemployment rate has declined at a faster pace than in previous recessions, but there is plenty of lost ground to make up. Only about half of the jobs that we lost in March and April have been recovered so far. So with that many people laid off and receiving unemployment claims, that also is preventing some people from spending money, which impacts our economy and markets. The prospects for effective COVID-19 vaccines and a faster return to normal improve the medium-term outlook. So we're looking forward about 3 to 6 months. However, the recent surge in coronavirus infections and hospitalizations could weigh on the economy and job creation in the near term, i.e. the numbers that I mentioned a moment ago when claims last Thursday increased above what they had been for the previous weeks, around 700,000 or so. Especially impacted will be industries like leisure and hospitality, which is coming off of 2020 as well. We don't think that unemployment will snap back to pre-pandemic level of 3.5% this year, but the labor market will continue to heal as our economy continues opening. Consumer spending has led our economy out of the recession towards the moving into Q3 and Q4 2020, largely supported by government income, meaning monetary and fiscal stimulus that bridged the income gap last year. As fiscal support is phased out in 2021, an improving labor market will take center stage or the lead in sustaining our growth in household disposable income. We believe further job gains and healthy consumer balance sheets will drive personal consumption higher. At 13.6%, the personal savings rate is double its 20-year average, representing pent-up spending power and concern about what's going on in the labor market. We expect that to return to normal. We do think that distribution of an effective vaccine and continued availability for you and I to get it if we so choose will ease a durable rebound in economic activity. Along with accommodated Federal Reserve and the prospects for additional fiscal aid coming this year, it suggests the newly emerging bull market has legs. What that generally means is we think that the markets will continue moving in the right direction with fiscal and monetary stimulus supporting that. As the economy improves, additional pent-up consumer demand for services will be unleashed. Interest rates will remain relatively low, spurring spending, and corporate earnings should continue to recover and likely reach their 2019 pre-pandemic peak by the end of this year. A handful of U.S. large cap or large size technology companies accounted for a disproportionate share of the market gains last year. Specifically, those 5 companies would be Apple, Microsoft, Amazon, Facebook, and Google, who rose about 38% on average, compared with a general 1% increase for the remaining 495 other companies in the S&P 500. We do believe that as the economic reopening accelerates in the second half of this year, the rally will broaden to economically sensitive investments that have lagged, including your small size companies here internationally and in the United States, as well as international large size companies. Cyclical sectors will face easy earning comparisons this year and trade at discounted valuations. But pandemic trends such as digitalization and staying at home are likely to last and will continue to support technology companies and technology stocks. We recommend investors maintain an appropriate diversification to benefit from the increased participation from stocks across all market caps, meaning small, medium, and large size companies, as well as investment styles and regions, meaning do they pay dividends, or are they focused on just growing, and regions, meaning globally, not just domestically here in the United States. We see further upside in stocks, but think that some of the gains were pulled into 2020 as valuations have expanded. The price to earnings ratio will likely normalize somewhat this year, partially offsetting the boost from an expected 22% growth in earnings. Therefore, we do expect moderate equity returns this year and likely a continuing decline in volatility. Nice to hear, a nice expectation. With that said, the path to a full economic recovery will be bumpy, triggering occasional episodes of market indigestion, although less likely severe than what we witnessed in 2020. I will say that with a caveat. That's barring that nothing else comes out of the left field like the original virus that we were introduced to in March. So assuming there's no major trade war with a foreign country, i.e. China, assuming that the vaccines that we do have available are effective against new strains of the COVID virus, and assuming that there isn't an unforeseen actual in-person war of any kind with any foreign adversaries. The Fed is likely and poised to keep its policy rate near zero to continue to stimulate the economy. So that's something that we would want to pay attention to, certainly if you're looking to refinance any loans that you may have. Good time to look into that. Or if it was a time that you needed to borrow money for some type of purchase, like a vehicle or a house or something along those lines, rates are continued or expected to continue to remain roughly where they are, certainly through 2021 and into 2022. Lower interest rates rise modestly as inflation ticks up. So inflation is something we always want to be cognizant of. We do like inflation to stay generally between 2 to 3%, closer to 2%. What inflation is the cost of goods moving up year over year. How much does it cost you and I to buy a loaf of bread today versus a year from now? Generally, that increase is somewhere between 2 to 3%, and that's where the Federal Reserve and the government would like to keep that. So keep in mind, you may see some modest increase in prices this year, but nothing earth-shattering from our expectations. The global economy is expected to recover similar to the US as the vaccines become available and the pandemic is expected to become more under control. We're looking at roughly more of the same from last year through the first 6 months or slightly more this year until vaccinations are widely available domestically in the US as well as globally to our peers overseas. The pandemic did hit the reset button on the economic cycle for most of the world's economies, not just our own. We do think that this year we'll see the global economy progress in the early stages of a new expansion that will support international equity markets as well as performance. Developed markets, in our view, will benefit from stronger fiscal and monetary policy coordination across European countries, which should help spur the recovery as European economies emerge from lockdown protocols. Several major developing economies, notably China, appear slightly further into the new expansion given the timing of their pandemic experience and accelerated policy stimulus. We think global GDP will expand in 2021 by the fastest pace since 2010, coming off the Great Recession. We expect US-China relations to return to the headlines. They've been kind of mum's the word over the last couple of months, primarily because of politics and what's been going on with the virus. While we don't believe the Biden administration will take the same approach as the former administration did, we do think that Biden will maintain a somewhat hardline stance on China when it comes to trade and national security. We expect existing tariffs to be used as leverage, particularly as policymakers seek to boost growth. We don't expect trade rhetoric to be quite as contentious as it has been, but we do suspect periodic tensions between the US and China will be sources of occasional market anxiety this year. International equities outperformed US markets in the early stages of the post-financial crisis recovery in 2010 and the phase of synchronized global growth in 2016 and 2017. The prospects of a renewed global upswing should, in our view, lend a hand to international market performance this year, supporting our recommendation for at least a neutral allocation to international equities as well as part of a well-diversified portfolio. The last time international equities outperformed domestic US equities was in 2017. Government debt is expected to rise to new heights, primarily because of additional stimulus, not just the $900 billion recently passed, but the additional $1.9 trillion that's expected in the spring, assuming it's in one package and not piecemeal. The pandemic has pushed our budget deficit to record levels. US federal debt will likely rise this year above 100% of GDP for only the second time in US history, the first being during World War II. Rising GDP will help slow the ascent, but with 50% of the budget going to entitlement programs such as Medicare, Medicaid, and Social Security, another fiscal aid package needed to help get the economy to the other side of the pandemic, government debt will continue to climb this year, so it's to be expected. This is not a pot set to boil over immediately, however. While debt as a percentage of GDP is headed for historic highs, it remains below levels that will initiate fiscal stress or insolvency as a country. Fortunately, the US remains one of the more vibrant economies in the developed world, and low interest rates will allow our government to borrow at low cost for some time to come. Nevertheless, shifting demographics and ongoing structural deficits are likely to make rising government debt a more prominent risk in the future. We don't think this will threaten long-term opportunities in investment markets, but elevated government debt does pose a headwind to potential economic growth over time. It can limit our flexibility on fiscal policy, raise interest expenses, and if unchecked, eventually crowd out private investments. We think these risks will become more acute decades from now, requiring tougher budget choices in the future. In the meantime, we think the Biden administration will explore opportunities for higher tax policies in an effort to raise government revenue. Not sure how likely that'll be with a 50-50 split in the Senate. If you're concerned about government debt risks, ensure appropriate diversification within your fixed income portfolio. That's the airbag in your portfolio, with the majority allocated to investment grade bonds. To address long-term government debt and interest rate risk, ensure proper allocation to global equities and domestic equities with rising dividend potential. So generally speaking, your blue chip companies. Let's see, some things to take advantage of or to focus on as we move into 2021. Some people like to refer to them as things on their to-do list for the coming year. Other people refer to them as different words that I don't particularly use because I usually let myself down. Make your financial resolutions. There's the dirty word. Revisit your important financial goals for 2021 and beyond with your financial advisor if you have one. If you're looking for one, don't hesitate to reach out. We're happy to be here for you. Review your budget. That's another dirty word, to determine your flexibility and then prioritize financial solutions. Depending on your situation, priorities could include replenishing your emergency fund if you had to dip into that over the last 10 months or so, Take advantage of any retirement accounts. And generally what I mean by that is if you can afford cash flow wise to max any retirement accounts that you have, take advantage of that. You do have the ability to make 2020 contributions to your traditional, your Roth, your SEP IRAs through tax day this year, which is April 15th, if you want to get those in for 2020's tax year. And pay any debt down that you can, assuming net cash flow allows you to do that. Also, increase your savings account towards any specific financial goals that you may have. That might be a vacation, paying off credit card debt, building up education savings accounts for kids, and those types of things. Review your diversification. As the market's focus swings between near-term uncertainties and longer-term growth prospects, we expect leadership among asset classes and sectors to rotate. We're already slightly seeing that. We've seen movement in the financial sector. We've seen movement in the energy sector. So pay attention to those sectors if you're heavily weighted in any particular sector. Cyclical and more economically sensitive areas of the market are likely to benefit as COVID-19 vaccines support a sustained expansion. What that means is those sectors that were hardest hit, like travel and leisure, restaurant, those types of industries, as we move through vaccines and vaccination availability, people getting back to work, they'll start spending money on those things that may have taken a back seat the last 10 months. Industries such as technology and growth-oriented investments are positioned for more secular growth trends this year. At the same time, periodic setbacks on the road to recovery will, in our view, favor allocations to bonds and defensive equity sectors. We recommend neutral allocations between stocks and bonds based on your strategy's risk and return profile. We believe maintaining diversification, which is key, across a variety of asset classes, including international, can improve your chances for long-term success and prepare you for the rotating market leadership. Setting appropriate expectations for your portfolio, paramount. Generally speaking, most people aren't invested to follow any specific market, so your values or your portfolio values aren't moving in tandem exactly on par with what's going on with the markets. Certainly if you're diversified correctly. So you'll want to maintain your expectations for returns as we move forward. While we do think bonds will continue to play important roles in portfolios, particularly as a buffer against periodic market pullbacks. That said, we believe interest rates will remain at fairly low levels this year as the Fed continues to keep lending rates near zero. We recommend reviewing the level of predictable income you expect from your bond portfolio this year. Consider overweight allocations to U.S. high-yield bonds as a way to enhance income. You may also consider laddering bond maturities or CD maturities as well. While equity valuations and persistent economic challenges are likely to produce bouts of volatility, we expect rising corporate earnings and supportive policy to point towards positive returns this year. Systematic investing, sometimes referred to as dollar cost averaging or making monthly deposits, and periodic rebalancing can help you navigate volatility this year. Keep your investment performance expectations realistic and your portfolio decisions aligned with your long-term goals to help you stay on track as we progress through this year and then moving beyond that. Create and update your existing estate plan. If you don't have one, I would encourage you to look into getting one. Generally speaking, that's what are your wishes while you're living if you can't make them or express them, and what are your wishes if you're no longer with us. So what that equates to is, do you have your last will and testament? Do you have your living will, sometimes called your advanced health care directive? Do you have your durable power of attorney for your financial And do you have your medical power of attorney for your health wishes while you're living? And if you have children, do you have guardianship documents in place? I also encourage you to review your beneficiaries. Now, as we move into the new year, is a good time to refresh and revisit those things if you didn't do it during open enrollment in the fall of last year. Beneficiaries on things like your checking account, savings account, CDs, your employer retirement plans, any IRAs you may have outside of work, as well as your life insurance policies and any annuities that you may have. Also, touch base with your CPA as you move forward to prepare for filing your taxes this year and collect all your tax forms so that you can work on getting that return if you're so fortunate early this year, so you can get that money to work because of the expected growth in markets and the economy this year. Matt, that's about it. Back to you, my friend.
Thank you, Shane.
You're welcome.
Very informative update as always. We appreciate your updates and your outlook. I mean, there's some positive things to be looking forward to in 2021, which we couldn't really say much of 2020. So again, thank you for your commitment to educating our members and our community on what's going on. And we look forward to your next quarterly market update.
Me as well. I'm looking forward to progress in the right direction on many fronts, not just in the economy this year, but in the markets. I'm looking forward to a very positive year. Not COVID positive.
Not COVID, right? And those of you that are tuning in, we are hosting a Fundamentals of Investing series that Shane will also be facilitating and teaching. And that series, the information can be found on our website. We'll be sending it out to the membership as well. That'll start in March, and there will be a session each week in March. So it's a 5-week course, and it'll be hosted here right at the Katy Area Chamber. If the situation with the pandemic is a little worse between now and then, we do have the option to potentially move it to virtual. So stay tuned. We'll keep you updated. And again, Shane, thank you so much for your time.
My pleasure. Happy to be here for the community.
I appreciate it. Have a wonderful day.
You too, my friend.
Bye.
Bye-bye.